Hi everyone. Under today's section, we'll be discussing your chapter B, understanding the accounting process questions. So make sure if you have gotten the tute, you have the tute, refer the tute first. Then afterwards, while you're watching the recordings, take your tute out, refer the tute. And then afterwards, when you're done with your lesson, make sure you do these questions, because that's the most important part, and these are the questions which will be tested in your exam. So to get started off with, so usually you get questions like this, where you have to drag and drop the question. Now, if you look at the first one, it says drag and drop the options below in the table provided to identify whether each of these items below would increase, decrease, or no change of owner's equity. So we have to see the items which would increase, decrease, or if there is no effect on equity. So we learned when we were doing the second chapter, the items which would increase your equity. So those were simply, I hope you remember, income, expenses, drawings, and your additional capital that we have. So those are the only 4 items which would increase your equity. Other than that, everything else, there is no effect. Equity is basically the portion which belongs to the owner. Okay? In Sinhala, we call it himikama කියලා කියනවා. එයාගේ හිමිකම වැඩි වෙනවා නම් equity goes up simply. So here first we have payment to creditor. So payment to creditor, there is no effect on equity, because cash goes down, credit also goes down. So here no change. So we can drag and drop A here. No change. Next, motor vehicle purchased on credit. Again, this has no effect on equity, because you're purchasing a motor vehicle, you get a new motor vehicle. This is an asset. Asset increase. And here, since you haven't paid for this, liability also increases. Motor vehicle debit and your motor vehicle payable account credit. So this also doesn't have an effect. So you can drag and drop here, which is no change. See, withdrawn money from the business. So we have learned what is that? That is drawings, So drawings would come. It would have an effect. So it would decrease your equity. So that would come. So you can drag and drop here. Next, we have an investment of equipment by the owner. So he's putting more resources into the business. So that is what we call additional capital. So due to additional capital, your equity would increase. So this would come here. You can drag and drop D here. Next, we have to find the sequence of actions describe the proper sequence of accounting cycle. So here first we have to get the proper sequence. First what we have to do is we have to post the entry. We have to post the entry. Next, what we have to do is close it. We post the entry in our ledger account. Then we close the account. Then if there is any adjustment that we have to do, or in other words, we have to adjust it in the trial balance. We adjust it in the trial balance. Then we prepare the trial balance. Then we enter into our financial statement and we do the analysis. Okay, so for the second one, it should be answer number C. Then we can move on to the next part. So again, we have a question where we have to drag the correct wordings of the following list to complete the sentence under accrual account. Accrual revenue is recognized. So again, you have to drag and drop. So you get questions like this. Since it's more online based. So here we'll look at the answers that they have given us. First, we have when it can be matched with expenses. B, only at the end of the financial period. C, only when cash is received. D, when it's earned. So under accrual accounting, we learn we record a revenue whenever it's earned to us. Now, if you take an example, say a customer came and paid us an advance to purchase goods. අපිට advance එකක් ගෙවනවා. We still haven't provided the goods to the customer. When we provide the goods to the customer only, we can record it as an income. That's when we have earned the income, because the obligation to provide those goods have been completed. So here, due to that, your answer should be D. When it's earned, you record. Fourth, you have determined the net profit for the period. If the beginning of the owner's equity is 20,000, cash withdrawn by the owner amounts 7,000, and the year end is 37. So we have to calculate the profit. Now I hope you remember when we were discussing the second unit, I explained you all an equation to calculate the profit, which is I'll just do it here, then it's easier for us. So profit equals NA1 minus NA0 plus D minus additional capital. Okay. So what this means is, again, if I explain, NA1 is your net assets, or in other words, net assets, we call it equity also. Okay. So net assets is, this is closing net assets or closing equity, and this is opening equity or opening net assets. Then we add back the drawings and we deduct the additional capital to arrive at the profit, because usually when you say profit, it's the difference between income and expenses. Okay. So drawings and additional capital, you know, under equity we adjust. So those should be removed. So then we get the difference between income and expenses only. Okay. So I explained when I was doing the lesson about this equation. So how we do this here is, now closing equity is 37. Open equity is 20. And we have drawing 7. So if they haven't mentioned anything about additional capital, that means there is no additional capital. Okay. So here we can simplify this. Here we get 17. Here we get 7. Then altogether we get 24. So 24 is the answer. This is answer number C. Next, you can move on to the fifth question. On January 1st, 2018, Vimal Traders has had assets worth 500,000 and owner's equity 300,000. During the year, assets increased by 100,000 and owner's equity decreased by 48. What would be the liabilities as at 31st December 2018? So we have to get the liabilities at the end. Okay, so what we can do here is, we can find, first we'll record the opening values and then we get the closing values using this. Okay, so in order to do this, so I will just do it here, then it's easier for you to understand. So now we know the basic accounting equation, assets equal liabilities plus equity. Now see, at the start of the year, we had assets worth 500, equity worth 300, which is, we can call it at the beginning, our balance brought forward. We have 500 and equity 300. That means we have liabilities worth 200,000. At the end, they say assets increased by 100. So from 500, it increased by 100. So their closing amount is 600. And your owner's equity decreased by 48. If it went down by 48, then this should be 252,000, because it has gone down by 48. Okay, so then we can just get the difference of this, because that will be the liability value. So if you get the difference, then you get 348,000. So that is answer number C. So then I hope you have understood that. Next, we can move on to the next question. If prepaid expenses are initially treated as an asset and required prepaid adjustments had not been made during the financial year, the financial statements of the current year would have been affected as follows. Okay. Here, if prepaid expenses are initially treated as an asset and a required prepaid adjustment have not been made during the current year, here what has happened is, then will be now when we do a prepayment, we do it for the next year. That is an expense relevant for this next year. But if it's included during this year as an expense, we have included more as an expense during the year. No. Then what we have done is, we have included more, and we have overstated our assets, no? Because we are including more as an asset. And also, liabilities doesn't have an effect, because now when you do a prepayment, you are doing it for the future. No? So you, now for an example, say rent. You pay rent for the next accounting period, you can use whatever that building in the next accounting period. So that is an asset. So you overstate the asset, but no effect on liability. And since assets are overstated, equity is also overstated. That means that would overstate your profits. Simply. Because assets go up, then your equity also goes up. Okay. Then we can move on to the next question. So here it says demand traders recorded sales received in advance of ₹8,000 and accrued sales revenue of 4,500 under sales revenue. The effect of these entries on total sales revenue recognized for the year is, now demand traders recorded sales received in advance 8,000 and accrued sales revenue 4,500 under sales. Now keep in mind, sales received in advance we can't record under sales because we still haven't provided the goods not to the customer. No. So but here they say it has been included, and also accrued sales revenue 4,500 also we have gone in. So we'll move on to the next question then. It says demand traders recorded sales received in advance ₹8,000 and accrued sales revenue of 4,500 in sales revenue. The effect of these entries on total sales revenue recognized for the year. Now here keep in mind, sales received in advance we are not supposed to record under sales because we have gotten an advance, we still haven't provided the goods. No, so if we go and record this would increase our sales. But accrued sales, keep in mind, we have already recorded, no, because this sale has been done before. Now you are supposed to get money from your customer. So this 4,500, then you don't have to record again. But 8,000, if you got an advance, you went and recorded, this would increase your sales. So due to that, your answer should be, it would increase your sales by 8,000. Next, you have tick the correct boxes in the table below. Show the correct classification of reasons when preparing bank reconciliation statement. So I explained in your bank balance and your bank reconciliation, or in other words, your bank statement, if you get differences, why you get those differences? That is due to unrecorded items, timing differences, and errors. Now, first one we have unpresented checks, that is a timing difference error. Bank charges, which is an unrecorded item. That means bank went and recorded, but we didn't record. Direct credit to the bank, that is also an unrecorded item. You directly get it to your bank, but it's recorded in the bank, bank statement, but it's not recorded in your books of accounts. Unrealized checks, those are timing differences, different errors. Okay, next we have to find the credit purchases. Now, we learned how to record credit purchases and all that, but we didn't record how to prepare an account. Okay, so here you can learn how to prepare. Now, keep in mind your credit purchases. How you come across credit purchases is due to your creditors, or in other words, we call them trade payables. Okay, so you have to make a trade payable account and find the credit purchase. So if you make a creditors account, usually since it's a creditor, it's a liability for the business. Okay, since it's a liability, opening balance will appear on the credit side because liability increase credit. So that opening balance we have 72.5, and cash paid to suppliers, cash credit, creditor debit. Liability reduces when you pay to your creditor. Discount received also, you get a discount from the creditor, creditor value reduces. So creditor gets debited by 2.5. Next you have goods return. So if we return some of the goods back to our suppliers, again creditor value will reduce. Goods return 1.5. Then closing creditor balance we have 92.5. Then what you have to do is balance. You get the total of this side, deduct this, and then you get the credit purchases out. So you can just take your calculators out. Here we get 180 plus 2.5 plus 1.5 plus 92.5. Then you get 276.5. 276.5 minus 72.5. Then we get 204 as your purchase. That is answer number D. Then after that we can move on to the next question. So I hope you wrote this down. So in this question we have to identify what are the source documents relevant for this transaction. No? So first we have goods purchased from Sandun on credit. So that is, if we purchase goods, that should be purchase invoice. Goods returned to Sandun. If we return it back, debit note. Cash sales, cash received journal, and paid Sandun by cash, and 10% discount was received. So when we are paying in cash, we put it into the payment voucher. We use the payment voucher to pay. And all this discount should come under your journal voucher, or you record in your general journal. Okay, so this should be answer number B. So I explained when we were doing the lesson what are the relevant journals and what are the relevant source documents relevant for those. Okay, so here we learn how to apply them when we get transaction. Again, in the next question also we have something similar where we have to identify the relevant source documents. Okay, so first we have goods purchased from Merun on credit basis. Again, that goes to purchase journal. Since you are purchasing it on credit. So all credit purchases go to purchase journal. Then goods return to Nelum. So goods return to Nelum should go. Now if you purchase, if you return it back, it should go to your purchase return journal. And cash sales would go to your cash receipt journal. Pay to Nelum by cash. So you're paying, so then that's cash payment journal, and this discount should be recorded in your general journal. So it should be purchase journal, purchase return journal, cash sales go to cash receipt, then the payment goes to cash payment, the discount goes to general journal. So it should be answer number C. Next we have allowances for receivables to be made in accordance with what accounting concept. So keep in mind all allowances, or we call them provisions. Provisions are made on your prudence concept. We learned a few concepts when we were doing the second lesson. So in the prudence concept, it says we have to record, we can't understate or overstate values, we have to record true values simply. Okay. So if we make a provision, so allowance for receivables is basically, now we are not sure whether the debtor would pay you or not. So what we do is, we remove a certain amount as an expense, a certain percentage, we make a provision. So we have to show that, we have to record that true value of that. So that's why prudence comes. Next we can move on to the next question. Again we have to calculate the net profit. So then you have to use that equation again. So the net profit calculation, I'll do it here, then it's easier. Here it says the following information, based on the following information, what is the net profit earned for the year ending 31st March 2030. Okay, so you can write down that equation, profit equals NA1 minus NA0 plus B minus AC, additional capital. Here I'm not going to explain the equation again because we discussed one question before also. So here opening net assets we have been given, which is 540, and closing net assets are 663,000. So net assets we call it equity as well. So this is closing equity minus opening equity. So closing equity is 663, open equity is 540, and here we have drawing 10,000, withdrawn 10,000, and additional capital 25,000. Drawing 10, additional capital 25. Then we can simplify this and get your profit. So you should be getting 108 as the answer. This is answer number D. So I hope all of you got that. You get questions like this a lot, where you get to calculate the profit. So make sure to use this equation. Then it's easier for you all. We'll move on to the next question then. Here again we have to find a missing value. So in order to find the missing value, or in other words, we have to find what is the credit sales using this information. So keep in mind credit sales arise due to debtors, or in other words, trade receivables. So here we will have to prepare a trade receivable account or a debtors account to find your credit sales amount. So you can draw a debtor account. So when you say debtor, it's an asset. So opening balance will appear on the debit side. So opening debtor, we have 22,000. Cash received from debtor, cash debit, debtor credit. When debtor pay you, debtor balance will reduce now. They don't owe you money anymore. So your cash, we have gotten 50. Discount allowed, we have allowed a discount to our debtor. So then they don't have to pay you anymore. So again, debtor balance will reduce. Discounted up debit, debtor credit. Due to bad debts also, bad debts is when your debtor doesn't pay you anymore. So due to bad debts also, your debtor value will reduce. Bad debt debit, debtor credit. And then you have the closing balance of this account, which is 52,000. Then you balance this. So keep in mind, whatever the amount that you're getting from here, you should get it from here as well. Okay. So here in total we get 57 plus 4 plus 52, we get 113. 113. You deduct this, then you get a credit sales amount. So when you do credit sales only, your debtor value will increase or your asset increase. So that's what we have to find, which is 91,000. So you have the answer 91,000. So I hope you made a note of this and wrote this down. We can move on to the next question then. So here they are saying the balance of the bank column of cash control of Renuka's business as at 31st July 2030 was 72,000. However, it has not been tallied with the bank statement closing balance. The following transactions were identified. So what we have to get is the bank statement balance at the end. So they have given us in the bank column the cash control balance that we have. So here, in order to do this, what you can do is you can prepare a bank statement to get this. So you can just draw a bank statement. I explained when we were doing the lesson how it works in a bank statement, how to record. So here you have the debit balance, credit, and you get balance here. So first what we can do is record the opening balance, which is 72,000. Then you have direct deposits via debtor to the bank account. Direct deposit, which is 28,000, which would increase your balance. Now here you are making from bank's point of view. Keep that in mind. So that's why when you have inflows, when you are getting cash, you credit the bank statement because you have to think from bank's point of view. Bank's point of view, this is a liability. Whenever we go and deposit money to the bank, that becomes a liability. But the bank balance goes up. So 28 plus 72, you have 100. Then payment made by bank on outstanding orders. On standing orders, so standing order payment. You have 15, which is on the debit side. Then you get 85. So we'll move on to the next question. So here it says the balance of the bank column of the cash control account of Renuka's business as at 31st July 2030 is 72,000. However, it has not been tallied with the bank statement closing balance. The following transactions were identified as the reasons for the imbalance. So here I hope you remember bank rec, what we discussed in your lesson. So in order to get the so here what we have to get is the bank statement balance. To arrive at the bank statement balance, we will have to prepare these two accounts. So first one that you will have to prepare is your adjusted cash account, and the next account that you have to prepare is your bank reconciliation statement. Okay, so here we have the cash control balance that we had at the start. We had at the start 72,000. During the year, we have direct deposit from our debtor 28,000. Now, how you record that is cash debit, debtor. So, cash is debitor, debtor creditor. We get from debtors a direct deposit of 28,000. And you have done a payment on standing order, which is 15,000. Standing order payment 15,000. Now keep in mind, those are the transactions which have not been recorded in our books of accounts. That means it appears in bank's books of accounts, not in our books of accounts. So that's why we have to record here. Then we also have, so unpresented, now this is a check not presented to the bank, and here we have a check unrealized. So those are checks which we have recorded but the bank has not recorded them. So those should appear in your bank reconciliation statement. I have explained why they are doing theory. But bank commission charges should appear in your adjusted cash. That means bank has recorded, but we haven't recorded. The business has not recorded. So bank charges we have 3. Then you can balance. Here we get 100, and your closing amount is minus 18. You get 82. Now that balance will be the opening balance of your bank rate. So we learned you add your unpresented checks, which are 34,000, and you deduct your unrealized. When we do this adjustment, we get 94,000 as your answer. So here we get balance as per bank statement. Balance as per bank statement 94,000. So yeah, that's how you do that question. We can move on to the next. So here it says the net profit of Medium traders for the year ending 31st March 2022 is 170. However, this was calculated disregarding the difference existed in the trial balance. Accordingly, in the subsequent investigations, the following errors were identified. Okay, so here they are saying we have a difference in the trial balance. A difference appears because there are errors. Now they have given us the errors. How this difference came. But what we have to get is the correct net profit for the year. Now we have an incorrect net profit, which is net profit 170. Okay, we'll see the errors, we rectify the errors, and we'll rectify the count. Okay, so first we have total credit sales 540 for the month has been recorded as 450. No? We have recorded less in the sales account and in the debtors account. So in order to record this, what we have to do is, so I will put it here. I will write the double entry here. So since we have recorded less, debtors account to be debited by the difference. You record 90 more, and sales account also you record 90 more. Debtors debit, sales credit 90,000 more. Next, cash discount 30,000 allowed to trade debtor has been posted only in the debtors account. So there had been a discount allowed, but we have only recorded in the debtors account. Now when it's a discount allowed, when we allow a discount to our debtor, that is an expense. No? Because for an example, say, you take this example, we were supposed to get 300,000 from a debtor, but we are only getting 270 now because we gave them a discount of 30,000. So that's like an expense. So you were supposed to get 300. So how we will record this is discount allowed should be debited by 30,000 because you haven't recorded that. You record it as an expense. Here it was recorded in the data correctly. So since this is a single length error, you have to put it here. Suspense credit 30. Now how we will record this in your net profit is, now sales was, remember, we recorded less. We recorded an income less, so you have to add 90 more to your profit due to sales. And this discount allowed expense, we never recorded that, no? We never recorded the discount allowed expense. So we never recorded discount allowed expense. We have to record that 30 as an expense. Discount allowed, we have to deduct from the expense. So next we have an interest income 15,000 received from a bank deposit has been credited to interest expense account. However, this amount had been correctly recorded in the cash. Okay, an income. But we have gone and put it to an interest income 50,000 received from a bank deposit has been credited to interest expense account. No. So an income we have gone and recorded as an expense. So first what we have to do is remove this from the expense account. So if you went and credited it, to remove interest expense should be debited. Debited by 15. And since you didn't record the interest income, you have to record the interest income. Interest income credit 50. Now will this have an effect? Income is getting, expense is getting debited, income is getting credited. This won't have an effect on your profit because expense increase, income also, sorry, expense reduce, expense increase, income also increase, no effect. So you don't have to record this transaction here. Next, the depreciation of motor vehicle for the year 20,000 have not yet been recorded after adjusting the above errors. What is the correct net profit? So depreciation we haven't recorded it since. Now you know when we depreciate an asset, that becomes an expense for you. So according to accrual basis, we know every asset, your value eventually reduces, no? So that is due to depreciation. Now depreciation is an asset expense. So then depreciation debit, debited by the amount which is 20. And we credit this accumulated depreciation account. Credit 20. So depreciation is an expense, accumulated depreciation credit because it's an asset decreasing account. So since depreciation is an expense, you will record that would affect your net profit. Depreciation